Hi, I'm Bert Nussbaumer from macrobeat.co.uk. Well, I guess you expect me to talk yields and stocks, and that's exactly what I'll be talking about today. I think we talked about yields last week when we started to really sort of enhance the discussion of what's really going on out there. We did expect the yield story to continue, and I think obviously everyone be aware that is really what's been the main driver out there this week. Not just in US terms, but we've seen very big moves in Aussie bonds, Kiwi bonds, around the global market. So this US yield or US bond story has really morphed into more of a global story in terms of whether it's inflation risk, whether it's optimism on growth. We shall see, but definitely the genie is out of the bottle from what it looks like. Obviously, we didn't have like these kind of same size moves in Europe. That's why, euro dollar might not have really participated as much as some of the other pairs. But clearly, the US story is the big driver. In terms of the Fed, obviously, Powell continues to do the talk. So do all the other Fed members, which is probably obviously going to be expected. The discussion is around just focusing on employment and take the eye off the ball in terms of inflation. But really, the market is speaking a very different language. And if you look at the market, there's clearly there's no smoke without a fire, I would say. Reality is the Fed has been behind the curve for years. In the last many years, it was the Fed that did adjust to the market rather than the market adjusting to the Fed. So come late in the year, if the data really would confirm the optimism that is out there for Q2 and Q3, I would definitely start to expect the Fed to change its language. And so I think the taper tantrum is going to be with us for the entire year, sometimes more, sometimes less. But I think the market sniffs the story, and I think it doesn't let really go at this point. The first slide I have for you is obviously the obvious one, 10-year yields touching 160 yesterday in the panic. So we had a rather sort of large move again this week. And on the other side, I think the next chart is probably the more dominant one that the market is talking about. This is yields versus the dividend yield from the S&P. Obviously, we had a crossover yesterday that was probably held to spark the sharp move lower in equities yesterday. This is definitely a crossroad. Whether this is already the real turn or if this is just a little hiccup we have yet to see. Obviously, we have month end, so some of the flows out there could well be month end related. So I think given it's Friday, given it's month end, I don't think we really judge or draw conclusions on a day like today. So we really have to wait for next week, see if equities bounce back, see if bonds calm down, and then we might just sort of, have a bit of more stable market. If the equity market fails to rally next week, then I think there might be real trouble in the making. On the next chart, we have dollar max. That one I just put up to sort of show what the sort of emerging markets is doing with the current moves in US yields. Obviously, emerging markets do not like higher US yields, and dollar max has now rallied a total of about 6.5% since the lows early or late in January. This is obviously a move that we were to continue on the top side if the US bond market is not calming down. So there is still some risk that this move could well extend. The next slide is gold. I warned about it last time. We're back again to the critical 1763.5 level. The last few times I didn't mind to buy it. This time I just don't trust if a big key level is getting tested for a third time. So I stand back and just see what happens. I would think the gold bulls are really getting frustrated, as it's really a big question of what does have to happen for gold to actually move higher. So there's still risks for another washout. Last but not least, the Dow, quite noisy there, but we have still not broken the mid-daily Bollinger Band 31,245. If that breaks, that would be the real wake-up call. Just below 39.50, we have the recent trend line from the October lows. So there's a few key levels to watch to really understand whether or not we are at the start of something bigger as in a major turn, or if this is all still rather noise than anything else. That's it from me. Thank you very much indeed. Bye-bye.